Real estate prices up another 5% by the end of 2020. What the heck are we talking about? Does this make any sense? I'm going to go through all of that in this month's episode of the Prime Properties TO podcast. Stay tuned. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of the Prime Properties TO podcast. It's Zhen here, and today I have a lot of things I want to share with you because I've been kind of condensing all of it for you guys so that it makes some coherent sense, okay? I actually have quite a lot of links and notes and numbers, so I won't be doing live math or trying not to do live math on the podcast, but there's a lot of things I do want to share so that you guys understand from at least what I'm seeing on what's going to be happening in the real estate market, okay? So the first thing I want to go through is there's a lot of headline on saying that there's going to be another increase of 5% by the end of 2020 in terms of prices, okay? So this report came out from Remax, and they're saying that by the end of 2020, they're anticipating prices are going to be up 4.6%. Or, media headlines run up to 5 sounds better, right? So is this possible? Okay, another 5%. Yes and no, and you're going to see why I say yes maybe a little bit later on when I go through some more kind of in detailed numbers. But 5% seems reasonable because it's about 1% increase a year. But the worry comes from the fact that this mortgage deferral that's coming, is it going to shock the world with a lot, or Toronto with a lot of inventory, right? But of course, the first thing you have to keep in mind, Remax, I own one, but it is for the sake of making business and profits, and they're in the business of selling real estate, right? So, take it with a little bit of grain of salt on whether it's true or not. But I will say Remax has been pretty accurate in the last few years, despite kind of what's been happening with all the craziness ever since like 2017. So they're saying that they're going to have a lot of increase in prices, not so much for kind of the existing areas of kind of like the Southern Ontario Golden Horseshoe, but more so kind of the outer areas that are going to be increasing the overall average price in Ontario, okay? So they actually broke down little segments, and if you're part of the newsletter, you're going to see that I kind of call out the areas, and you'll see all the numbers. So make sure you subscribe to the newsletter. I'll put in a link in the description below or the show notes, okay? So what's actually leading the pack in the most, what Remax is anticipating for highest increase is actually Muskoka. Yeah, they're anticipating another 11.51% increase from now until end of the year, which makes total sense because cottage country has been hot with everyone working from home and everyone thinking that working from home is going to continue that way, okay? Now, when it comes to Toronto proper, right, which is where we are right now, they're anticipating their 6.67%, which is actually a little bit higher than their 4.6%, because we're, again, talking about all of Ontario, right? And then you have other areas such as like Sudbury, they're actually anticipating a decline. So it kind of ranges, but like I would say in the GTA area, it's varying on the low side from about 6.5% all the way to about 8%, which is kind of in like the Peel Durham area, okay? Which is where a lot of the houses are a little bit more affordable. So the reason I'm bringing this up is because a lot of people always ask me like, well, how's it looking? Our sales are actually happening, right? And from trading in July last month, I would say it was like crazy red hot, right? And I thought we would taper off a little bit in August, where we're going to maybe still see the same amount of kind of activity, not same amount, like a little bit less activity and a little bit less sales. And we'll find out in like a week or two, right? But to me, it didn't actually feel that slow in July, and it was really busy. And then it didn't feel much slower in August either, which kind of felt like the same as July. So the demand from the buy side is still there. And then the people who need to sell are still there as well. Although there's a lot of people I'm speaking to that want to wait until after Labor Day before they list their house, which is kind of normal, I would say. We will probably and normally get a little bit more inventory come September after Labor Day, because that's usually how it happens. I mean, with COVID happening right now, I still think that's probably a sign, plus that and the mortgage deferral, okay? So all in all, I'm saying August is a little bit busy. I wouldn't be surprised if the numbers that came out in a week or two to be similar to what July is looking like. And the other interesting thing about kind of trading in August is the rental market's been a little bit hotter than normal. I know last week I was talking about how I was comparing year to date January to July, the amount of properties that were actually leased was only 5% less last year. Okay. So that means if, 1,000 properties leased this year, only 950 were leased 950 were leased this year, 1,000 were leased last year. So the amount of people leasing properties is about the same. It's just that we're having a surplus of supply. And this is going to be the underlying theme of kind of the podcast today. Like, are we going to have so much supply that it's going to change our pricing, or are we going to absorb all that supply? Okay, so I wouldn't expect August to be not that much worse than July, probably around the same. And if Remax is correct in the sense that we're going to get about 1% increase per month for the rest of the year, I suspect the activity will be staying the same. Now, one of the interesting things that the report says is about a third of the people that they kind of surveyed, they want to leave the urban areas like downtown Toronto. And then the other 44% just want a home with larger space, okay? Which is kind of telling us that the small one bedrooms in downtown, because you have to work near your office or anything, is no longer in demand right now because of the pandemic. Plus, if you have ever actually gone into a condo right now, that's like a lot of floors and a lot of stories, then it actually takes a while to get to your unit if you live on a high floor, because you can't jam everyone into an elevator anymore, right? There's social distancing in the elevator. So there's a lot of people kind of trying to stay away from that. And that's why high rises are not as popular right now. And that's why we have a lot of inventory, because there's not much demand for it. And the inventory keeps piling up, okay? So the second headline I want to bring to you is like TD came out a few days ago and basically said that it looks like we got a V-shaped recovery. So in just 3 short months, the Canadian resale activity basically had a V-shaped recovery is what TD is saying. And yeah, I can believe it, because we hit new records. We got a new highest average price. The activity is through the roof. The months of inventory, which I track quite closely, is at the lowest all-time ever right now, even before pandemic level. So it's just all kinds of crazy right now. And some of it doesn't make sense, but some of it does. So people are kind of pent-up demand. But there's a lot of people just kind of cautious about what's coming down, and which is why, again, underlying thing is supply. Now, in TD's report, they're saying that a lot of people, and I don't know how they came up with these numbers, they're saying that the pandemic hit the people who were on the lower income side, and because maybe some of them were in jobs that were kind of dependent on, say, like hospitality or maybe travel, because all of that hit the pandemic really hard. So if you were in one of those industries, then you probably felt it pretty hard. But if you were kind of like working at one of the larger firms, maybe like a EY or KPMG or Deloitte, one of those, like people are still working. There are some minor layoffs, but from what I heard from kind of my circle and like my clients, they just ask you to maybe take a little bit of a pay cut so that you keep your job. But realistically, everyone still had their job and they're just working from home. And the whole world right now is adjusting to working from home. And I think they're kind of liking it, as long as they're able to have time to kind of do the work at their home. And that's why people want more space, right? Try working with a bunch of kids around you. Like, I just got a dog, and working with the dog around me, kind of looking for attention all the time, is very difficult. He is down here somewhere roaming around, but I had to time out before I did this podcast. So yeah, it is very difficult. So those are 2 major reports of kind of the market rebounding. Obviously, I was saying Remax is in business for trading real estate. TD is for business for lending out money. So maybe they're a little bit more optimistic, but take it as how you want to see it. It's not me trying to convince you of anything. It's just there's a lot of big people coming out saying that the market is kind of recovered already. So I tend to believe that. Now, one of the crazy things, in regards to why TD is saying that it's already recovering and may even continue like that, is we got a new Minister of Finance. His name is Tiff, or his short form name is Tiff. And it's a really weird thing, okay? Like, he basically came out after, I forgot what the other guy's name, not Bill Morneau. You know what? I am not going to say because I don't remember right now. But like, normally no one will give any predictions for interest rates on like coming in the future, right? But Tiff came out after basically his name was Polos. Yes, that's what it was. Stephen Polos. But Tiff came out and basically said, you know what? We're going to, here, I have the quote saved. We are going to be keeping interest rates low until 2023. 2023. That is 2.5 years from right now. So if interest rates are staying low, if you talk about real estate, that means mortgage rates are probably staying low as well, right? Obviously, banks control it, but if the cost to borrow is less, then that means there could be some incentive for people to keep buying more, or maybe they qualify for more. It's really, really weird that he would actually come and say this, because like sometimes before, like Polos would like telegraph like maybe a few weeks in advance what the Bank of Canada interest rates looking, maybe increase, stay, or going down. But this guy is like 2.5 years out. He's like, yep, we're going to keep interest rates low. And one of the reasons I do think that is there's probably a mandate from the actual like government, like Trudeau's government, saying that we do have to keep interest rates low because we've printed so much money right now, right? So this is the part where I want to talk about a little bit of inflation. Like if we look at Canadian, the balance sheet ever since the pandemic, we basically were around about 100 not million, 100 billion, okay? 100 billion. So we had that much money in debt. And ever since the pandemic, we're now at 500 billion. So we 5x'd our debt. And this is, from handing out CERB money, paying your deferrals, buying back, freeing up liquidity for the banks, right? It's to kind of keep the economy going so that it can't collapse because of the pandemic, right? So one of the things that Trudeau came on and said the other day was when someone asked him, what are you doing about all this money that you're giving? Because like I think Canada is giving out the most money to anybody, right? Like we're getting CERB, which is ending soon, but $2,000 a month, whereas I think the U.S. was waiting to get a $1,200 stimulus check just one time, where we were willy-nilly handing out CRB payments. And all you really had to do was log into CRA and click a button or call and press a few like dial tone numbers, and then you got your money deposited into your bank. Like I applaud the government for being so quick in getting money into people's hands, but that's a lot of money that they're sending out, right? And don't forget, even though CERB is coming to an end, and I called it, I don't think it's going to end, they're turning it now into the Canadian, not emergency, but Canadian response benefit, which is kind of like an extension of EI. Frankly, I think it's a good thing, but it's so easy to qualify for, even for anyone who wasn't working, because all you really had to do was work, I think like 150 hours or so, which is like 3 weeks, right? 3.5 weeks maybe, depending on what you do. And you qualify for another 9 months, okay? So 9 months, 50, another 6 months of $1,600 a payment, $1,600 a month payment, or $400 a week, which is crazy, right? So now we're extending this money out there some more. Now, they're saying that they're kind of trying to increase the stimulus of getting people back to work because it gets capped off for how much money you make and then becomes taxable and all that stuff, which is the same with CRB. But unless how to put this directly? So unless you absolutely need more money than that, it really doesn't stimulate the economy more, because people, yes, you're getting $400 less than CRB, but the incentive to work is still not there, right? Because I think they're capping you at like $32,000 or $35,000, which is basically minimum wage. So if you ask someone who's working a minimum wage job, do I sit around and get EI because I worked 3 weeks last year, or do I go back into the workforce? They're probably going to pick the former because they don't have to work and they're still getting the same amount of money, right? Living your best life. So there's a lot of money being printed right now. And back to what I was saying earlier, when Trudeau was asked, what are you going to do about that? He kind of like laughed it off and chuckled and said, do you know how that works? What our interest rate is? He's basically saying that the cost for us to borrow this and print this $500 billion is basically laughable, because the cost to service the loan is very little. Basically meaning that if they're planning to keep the interest rates this low, they plan to probably keep printing money for a little bit longer, okay? And they don't see an issue with that. And if they continue with the interest rates low in 2023, the unfortunate side effect of all this money printing is that your money that you're saving in your bank account or whatever becomes very, very worthless almost, okay? Like I was trying to have this conversation with my sister-in-law the other day, trying to explain the concepts to like someone who's a little bit younger. And I'll try to explain now. Like if the entire world had 10 apples and a finite amount of money, call it $10, then in theory, every apple is worth $1, okay? But if all of a sudden our Bank of Canada is like, here, everyone have an extra dollar, and now there's $20 in the world, people are willing to pay more money for this limited supply of 10 apples. So maybe now they'll pay $2 for it because there's $20 in the world. There's 10 apples. I'll really pay $2 for it. And this is what inflation is doing to the cost of our hard-earned money, okay? It's making it worth less and less. And it's been driving me insane the last 2-3 months because I can see it in my eyes and see it in like my daily life where it's actually costing me more to buy things. So off a little tangent, but like I go grocery shopping and I go buy basil, which is like a herb that my wife and I use a lot. And the grocery store we shop at, which is like the Chinese grocery store in Markham, is usually $1 for basil. 3 months ago, it was $2. And then after the pandemic kind of slowed down into phase 3 when it was grocery shopping, it's now $4. So in the course of like half a year, it's 4x the cost. Okay. I was telling this to Amy on the team as well, right? Like, there's like a beef balls, kind of like a Chinese meatball that we usually get. The brand that we usually buy from increased their price from $6.99 to $9.99 in the course of 3 months as well. That's 50% almost their price in 3 months. Okay. Now, whether that's inflation or not many people want to go to work, all of that contributes to inflation, right? And then the other one is like haircuts. If any guy out there will probably understand, like I didn't get a haircut in a barber for a very long time. My wife was cutting my hair and it was fine, but I don't want to bother her anymore with it. So I decided after it was safe, put a mask on to go get a haircut. And it was really weird getting your haircut kind of with like the strings around the mask, but it was done nonetheless. But my barber increased his price by another 30%. Okay. All of this is all adding up. So the cost of inflation is hurting how much money that we actually, like what our money is actually worth. So unless you're seeing this like 30-50% increase in your salary, so if you're making 100 grand, are you making 130 now? Are you making 150 now? There's no way your cost of living is going to be slower than how quickly your income is going to increase. Like if you're lucky and in one of the larger firms, you're going to get maybe like 2 or 3% inflation pay, right? Which is fine, right? But now we're seeing inflation way higher than that. And even though Canada's mandate of inflation about 2 or 3%, realistically, we're seeing inflation go much higher than that. And I'm telling you all of this is because it's related to the cost of real estate. When there's so much money being printed right now, it all goes into something. Kind of like my Apple analogy, right? If there's only 10 finite apples in the world, then the cost of those apples go up as more money is being printed. So if there's a finite amount of real estate in Southern Ontario, because again, we have a supply issue, right, for the time being, is that money going to be going into real estate? We saw it happen in 2010 to about 2015, where there's a huge ramp up in price because there's not houses to buy. And I'm not going to go off on a tangent again, but basically the Ontario government is very, very bad by slowing down builders by putting too much red tape in front of them to build new houses. We don't build enough houses for how many people come to Ontario. Again, conversation for another day, but we have a supply issue. So is all this extra $500 billion, how much of that is going into stocks? How much of it is going into real estate? And how quickly our prices can go. So if you've been watching some of my YouTube stuff or been kind of talking to me in the last 2-3 weeks, I'm really, really, really concerned that in the next 2 to 3 years, I don't know when it's going to happen, but there's going to be a part where we're going to see hyperinflation, where it's like, all right, the pandemic's behind us. There's a whole bunch of money out there. The banks are very loose with their lending, or they're still tight with their lending, but they're going to be looser with their lending because the banks, Bank of Canada bought back so much of their debt, and now they're going to lend it out willy-nilly. How much of that is going to drive the real estate prices through the roof, right? We saw the S&P 500 hit record highs because money was going in. It's easier to buy and sell trade stocks. It's a lot slower for real estate because there's a delay. But are we going to see a delay that's going to cause the hyperinflation of prices going up? So that's one of the concerns I keep worrying about, where how crazy are prices going to be knowing that, one, we're keeping interest rates low until at least 2023. The dude said it, Tiff, okay? Which is really rare. 2, Mr. Trudeau is still printing money, and he thinks printing money is fine as long as he keeps interest rates to service the debt. 3, we have a lack of supply, right? So when you marry all these things together, it seems to me like it's like a great storm for real estate prices to go up. Again, I'm not saying it's 100% going to, but I keep seeing these signs there. And yes, it may sound about self-serving because, again, I own a Remax, we trade real estate, but I'm just trying to provide this kind of information so that you can understand how the money system is right now. Like money is being printed, and the money that we have is becoming worth less and less and less. The amount of apples you can buy is less. The amount of real estate you can buy is less. So is it time for you to take action? Again, that's ultimately up to you. I know we are in the midst of doing some refinances to get ready to buy some more properties, because I am like 99% sure that this hyperinflation is going to come. And I rather have my money plus kind of the low cost of borrowing right now on all the properties and just put it out there so that it's in an asset being paid for by tenants. That is what I'm doing, or I'm planning to do. What you want to do, ultimately up to you. But I just want to put this information out there, okay, so that you can kind of understand what's happening. Because the worst thing is you don't see inflation happening. And over the course of 10, 15 years, that compounds and it becomes ridiculously significant in terms of what your money is worth and how much you're saving, what your income is. So you have to find a way to protect your financial future. It doesn't have to be real estate. You can put it into stocks if you like stocks. I just like real estate because I can control it, right? Because I own the property. Now, the second thing I want to kind of talk about was this worry about the deferrals coming due, okay? So mortgage deferrals basically started in May, and similar to CERB, it was really easy to get. You can basically just call your bank, be like, hey, I need a deferral, no questions asked, click, 6 months deferred, okay? So now the 6 months is coming to an end, and there's a lot of worry about whether people can actually pay for their mortgages, whether they're back to work or not, or if they're gonna have a hard time, and then there's gonna be a lot of inventory flooding the market, okay? So the thinking goes, if we have a certain amount of mortgage deferrals, people who quote unquote needed it, and they're still no longer able to make these mortgage payments, then they're going to go into something called default, okay? Which is the bank saying, hey, you haven't paid your loan. We're going to come take your house back, and then we're going to sell it to make sure we get our money back. Keeping that in mind, the bank is not in the business of owning real estate and selling off foreclosure. In Ontario, the foreclosure process is anywhere between 6 to 18 months. And I suspect if there's a huge backlog of it, it will take even longer, right? But the bank's not in the business of selling houses. They're in the business of lending you money, underwriting it, making more money come out of thin air of the other mortgage so that they can collect their interest from you on it. And that's how the banks make money. And that's why the Canadian banks usually win. Now, with the deferral, the banks, obviously their balance sheets don't look great in the last 2 quarters, but kind of like CERB, so what I was saying it was going to get extended, maybe reduced, are the mortgage deferrals actually going to come to an end, just screeching stop, right? I actually don't think so, because if the Canadian banks saw something that happened in 08, kind of like the US market. Once everything came to a screeching stop and the houses were worth less than what the mortgages were, everyone was like, peace, I'm out. They dropped their keys, right? Obviously, in those situations, US has something called non-recourse loans. They don't garnish your wages, so it's easier to just drop the keys and leave. In Ontario, they can come after your wages, and they can also foreclose your property, which I'll get into a little bit later. But the idea here is that the banks aren't in business for that, okay? So are they going to maybe secretly give mortgage deferrals, extend it a little bit, maybe say, hey, you can make a half payment, we'll amortize the other half into the back of it? I really think that's going to happen, because they don't want to see kind of the collapse of real estate, because it's such a big economic driver of Canada. I think Canada, 12% of the GDP is created from real estate. That's almost territory of too large to fail. It's really, really big. So they're probably going to try to kind of, if it's going to come off, maybe skid off a little bit, maybe extend the mortgage deferrals a little bit. I don't know what they're going to do. I personally just think that maybe people who really, really need it will require more paperwork to prove that they need it. And then they'll make kind of payment plans, kind of like with the landlord tenant board of the rent payments, right? I think that's really what's going to happen, okay? But the interesting thing that I've been kind of doing some math here, and I think this is where I have to do some live math, okay? Scotia is saying right now that most of their deferrers are what they're called super prime, okay? I don't know what that means. I think they just made it up. But basically, they're saying that these people who ask for deferrals own more than 40% of their property, or 40% in equity, okay? And I suspected that was the case, because unless you bought your property a year or 2 ago, you're probably sitting on a ton of equity just from the gains of the Toronto real estate market. So the question becomes, if you as a homeowner bought a home for $500,000, $500,000 5 years ago. It's now worth $700,000. Okay, you hold 40% of the equity. That is $280,000. Okay, you own for the property out of the 700. I think somewhere around that, maybe bad math. But anyways, are you going to scrap, borrow, find, ask friends, family for any kind of way, or maybe even to bank to extend the mortgage deferral or make prepayments and then amortize it so that you still own that property? Because in the foreclosure process, the banks take it and they sell it, they make their money. Then you get the leftover profits if there are any, but you can't control the price. Okay, that's the important thing. But wouldn't you want to control your property, find whatever that you need to make the mortgage payments, even if it's half of it with the payment structure, and hold on to that $280,000 you have in equity? My answer is yes. You would too, right? Because you own so much of it. And even if you know, or you're freaking out that you may not get a job for the next year or so because maybe you're in like air travel and no one wants to travel for the next year, at the very least, you can probably find a way to pay the next little bit, and at least like the next little bit of the mortgage, and at the very least, control how much you sell your property for. Meaning that you still make your payments. The banks aren't like, Mr. and Mrs. Bob, we're going to come take care of some foreclosure. At least you can still be like, hey, I want to sell my condo or house, whatever it is, and then take that $200 in equity and do something with it, find the rent, downsize, whatever, right? And that's where we're probably seeing like a push out to the places that are less expensive, right? Because some people maybe are downsizing right now. So having said that, these super prime 40% equity people, how many of them are actually there? How many of them actually took the deferral, right? Like I've asked some of my clients who took deferrals, most of them, because most of my clients are investors, are just like, you know what? I'll just take it because it's extra cash flow. You know, your mortgage payment was $1,500. You stop it, you free up another $1,500 in cash flow because we're in emergency time, having some extra cash. Fine, not a problem. It didn't affect you as long as you weren't trying to buy another property where it shows up on your credit report, like I was saying before, right? So, how many of the people are out there? One of the interesting things that I was following, to circle back to this, is the head of CMHC, Evan Siddell. Sorry if I pronounced your last name wrong. He's been very active on Twitter, and he's also new. And he's been kind of Twitter feuding with some people, but he came out with a stat, and I'll put it on the screen here on YouTube, or it will be on my newsletter as well. So make sure you subscribe to that. Basically, he said that every single province, what the percentage of the total mortgage deferral is. Okay. So in Ontario, he said the total mortgage deferral under CMHC is 10.1%. That means 10% of all the mortgages right now are in deferral in Ontario, okay? So, being the giant nerd I was, I went to Canada Stats, Googled how many houses there are in Ontario. It's about 50 million, okay? That's a lot, okay? So, let's just say 10% of that, 5 million. I think I'm doing bad math already. Hang on, I wrote this down somewhere. Okay, yep, I totally did some bad math. I took the wrong number. It's not 50 million, it's 5 million. So there's 5 million households right now. Let's just say they all have a mortgage. Realistically, some of them are probably paid off, but for the sake of simplicity, okay, all of the 100% of the houses in Ontario, 5 million of them have mortgage. 10% of them are in deferral. That's going to put you at 500,000 houses that are in deferral. So let's say how many of them are actually going to need to sell their home come the next few months. Let's just say 1 in 10. Okay, that means there's going to be a 1% default. It could be higher, it could be lower. So that means there's going to be 50,000 homes that's going to come on the market, assuming they all go into deferral at the same time. Obviously, it'll probably be staggered because some people will try to extend their payments. Some people will try to hold on to the house. Some people are like, forget it, I'm out, peace, and they'll sell it, right? So I don't think it's not going to be like all 50,000 comes in all at once, right? But it'll probably stagger it out maybe through, the next 12 months or something like that, okay? So now I go circle back to the TREB data. Last month in July, there was an active listing of almost 18,000. 15 of them got absorbed, and we got 50 new ones of the active ones, okay? So I mean 2,000 carried over from last month. That means if 50,000 properties in Ontario, okay, let's just say most of the mortgages and whatever in Southern Ontario. So even though I'm talking strictly about like GTA numbers, let's just loop in Ontario numbers just to kind of juice it up a little bit. So if 50,000 properties immediately comes into the market right away, That means we're effectively like tripling our inventory. Okay. So the question I've been asking over and over and over again in the last month or so, do we have enough demand if we tripled our inventory? So let's just say demand is exactly the same right now. Like I said, last month we did 15,000, okay? 15,000 sales. We do 50,000 coming in. That's 3 point something months of inventory. Let's call it 3.5 months. 3.5 months of inventory is still a seller's market, a very weak seller's market per se, but it's not in a buyer's market just yet, okay? Now, that's assuming we don't add on to any existing months of inventory right now. I think the months of inventory right now is like 1.7. So we're going to be at 4 or 5 months of inventory, which is an exactly balanced market. Okay. So let me recap what I just said because it was a lot of math. If 10% of the Ontario mortgages, assuming it's mostly Toronto, okay, which I know it's not, okay, and also assuming 5 million households all have mortgages, that means 1% of the deferrals have to go and sell. 50,000 properties come on the market. We'll have about 4 months of inventory, which means we probably can absorb most of it, assuming demand doesn't change. That's scenario like equal number one. So I think we'll be okay, again, because this is all coming right away and it's not staggered. It probably will be staggered. But let's say it's staggered, then that means we'll probably absorb all that inventory very quickly, especially if it's a freehold home, because the freehold home, the months of inventory right now is like very close to one, if not a little bit under. There's like no supply. Okay. We'll probably find out in a week or two, like I was saying. So when it comes to specifically Toronto proper, I'm going to say if that percentage of supply comes in as freeholds, I think we're going to absorb it. No problem. Condos, on the other hand, they have been kind of slowly slowing down, and they were around like 2.7 months of inventory. If that level of supply comes in to the condo market, I think it may push us into the buyer's market, like over 5 months, which could be problematic. But again, this is assuming all of it comes in all at once, right? Now, the other equation is it only going to be 1% of the 10% that needs to sell, or is it 2% or 3%? Because based on the numbers I just told you, every percentage increase will double the amount of inventory that we're going to get. And that's the question that I don't have an answer to, right? How many people are actually going to need to sell their home? And when they sell the home, are they going to extend the mortgage deferral and then sell it? I have no idea. If Scotia is right on the fact that, these guys, 40% of the people who, or so not 40%, and most of these people who are asking for deferrals are quote unquote super prime people and they own 40% of their equity, yes, they're probably less likely to defer maybe, but if they're in a bad job position and they can't make any mortgage payments, they're still going to have to sell. It's just, it won't be foreclosure. So that it's kind of giving me optimism that the amount of inventory coming on the market in maybe like September, October may not be as high, but worst case scenario, which I always plan for, it very much could be. We have no idea. And the fact that Evan Siddall came out and gave us these numbers is fantastic. My question to him is, are these mortgages that he's talking about and deferred, are they insured or uninsured? Basically what that means is when they bought them, are they have more or less than 20%? Because if you have more than 20%, your equity is high, you're less likely to have to sell. But if you're saying that they have less than 20%, 5% or something, and the prices come down, they're like, well, I don't own much equity, gone, right? It's going to sell. So that's going to be a big dictator. Now, he never indicated that on whether it's insured or uninsured, but those are the numbers and what's kind of like given us a sneak peek into what CMHC has shown us, okay? So everything I've told you, inflation, this mortgage deferral, I'm optimistic that the market is going to be fairly strong in the coming little bit. But if things, turn really sideways, maybe there's talk of a second wave coming because the kids are back in school, who knows? It could really change everything. That's what I said. Like, I have no idea what's going to happen. It's just from what I'm seeing, I would rather be a little bit bullish where I want to make sure I have a property that pays for itself with good tenants, right? They're going to stay there for long term, maybe not a condo right now, maybe depends on what your strategy is. But the idea is, I know money is going to become worth less, but I'm worried how much the real estate market is going to be changing with the mortgage deferrals. But the optimism comes from the fact that a lot of these deferrals may not actually have to sell. And even if they do, from the numbers I just told you, it should be staggered out through the course of 12 months. And maybe the trickle in of supply should be absorbed based on the amount of demand we've been seeing in the last 3 months. So that's kind of what I'm seeing and hoping that you guys understand that. Now, one of the minor little things that I would just throw in here, just because it's kind of funny, is A few weeks ago, CMHC came out, which is basically the large crown corporation of mortgages, right? So they were like, hey guys, you're lending too much willy-nilly to the banks. And they basically made it more difficult for anyone with less than 20% to buy. They like reduced their buying power. They tweaked some rules that normal CMHC stuff does, and said that we're no longer going to insure these unless they meet these requirements, credit scores a little bit higher, income, yada, 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 whatever, right? So the banks are basically like, well, CMHC, if you're not going to insure this, we're going to go to the other guys like Canadian Mortgage Insurance or Genworth, and they continued to get the normal rates. And they basically just, instead of getting insurance from the Crown Corporation, went to another insurance company to get insurance so that it can keep lending out. So again, this is an impact of what I'm talking about, where the banks are in it to make money. And if even though CMHC is making all these rules that they can control but not control others, they're saying, hey, why are you guys doing this? It's very risky. But the banks are, again, in it to make profits for business, right? So they just went to the other insurance companies. And so Devin Sadell, again, came out and said, this is a bad idea, bad option. He actually made a public letter to the bank saying this is unreasonable. And while he does have merit, I just find it very, very forthcoming in the sense that he's very transparent in the fact that he's very bearish on the market, and he's trying to slow it down, but then there's other kind of factors pushing it the other way. And it's very interesting to see, because you can see that there is a divide between how people view real estate, whether it's very bearish or very bullish. It really is up to you. And if I can still see the banks are lending, I'm a little bit optimistic about that, because there's a lot of people who get paid a lot of money at the banks, much more than my pay grade, that to kind of look at economics and trends. And they're still lending because they're trying to make money, and they believe in that real estate is still a little safe, even with all the mortgage deferrals coming, and the fact that I still believe hyperinflation is coming. I would tend to believe of them as well, that I think in the long run, if you can get a property that pays for itself, then you can ride out the bad times that is happening right now, this pandemic, whether it's a second wave, third wave, whatever. As long as it pays for itself, hold on to that asset so that when the hyperinflation comes, you're going to be in a position to capitalize on that. And that's how you're going to keep your money valuable, as opposed to just leaving in the bank and having like the amount of apples you can buy worth less and less. So hopefully that kind of gave you an idea of the thinking that's going behind my head, and why maybe I'm a little bit bullish / bearish. It's kind of like in the long term, I think real estate is going to be good, but it's just how are you going to protect yourself in the short term, right? Because you don't want to overextend yourself, especially during a pandemic. So those are all the thoughts I've been having in the last 2-3 months, kind of wrapped up cohesively through the notes. If you guys found this helpful, make sure you give a like on YouTube, or give us a review on Apple Review if you're listening to the podcast. And if you have any questions regarding some things I said, you can leave them in the comment. I know this podcast may be a little bit controversial, or someone will fact check me on something. I'm happy to have conversations in the comment section below, okay? And if you guys want further information like this, make sure you subscribe to the Prime Properties TO newsletter. I'll put a link for the subscription in the show notes or in the description if you're watching this on YouTube, okay? And until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.